Well, at the beginning of the year, it's just natural to focus in on tax-free savings accounts now that new contribution room has been announced. And so in this video, I'm going to cover off 9 crucial facts about tax-free savings accounts and 7 mistakes you need to avoid so you can maximize the potential of the TFSA for your retirement planning. Now, bottom line, of course, tax-free savings accounts provide tax-free growth. So any interest income, dividend income, capital gains income you generate is growing tax-free, and better yet, when you pull the money out, it comes out tax-free. Who's eligible? You have to be age 18, you have to have a valid social insurance number, you have to be a Canadian resident. If you hit those boxes and you can check it off, then you can set up the account. Now, the current contribution room, as of 2025, stands at $102,000. So, when these accounts were established in 2009, and let's say you hadn't made a contribution and you were 18 at that time, your cumulative lifetime room would be $102,000, and the current room for this year is $7,000. And you're probably already aware of this when it comes to contributions. There's no tax credit, there's no tax deduction on a contribution, but you do get the power of tax-free compounding. One of the biggest questions that comes up with tax-free savings accounts, and particularly when you have to make a judgment call on how to use your dollars, you may not have enough money to do all the things you want to do between, do I make a tax-free savings account contribution, do I make an RSP contribution, or do I pay down debt? And that's really a function of 3 important factors. What's your marginal tax rate? What's the interest cost on your debt? And what kind of returns can you get on your RSP contribution or your TFSA? Now, if you're not sure about what to do, the first default is just park it in the TFSA, because you can always pull the money back out at any time from the TFSA without penalty, without taxes. So the way you want to look at this from a tax standpoint, let's say my marginal tax bracket is 40%, and I think it's going to be 25% when I retire. Well, in that situation, you might be better off making an RSP contribution. You're getting a great tax deduction, and you're pulling money out at a lower tax rate. If your marginal tax rate is constant over time and there's not much fluctuation, you might be better off making the tax-free savings account contribution. However, if you're carrying debt and the debt costs you 7% and you don't think you're going to get much more than 5% in your portfolio, you might be better off ignoring both the TFSA and RSP and focusing on debt reduction. Now, every situation's different, and if you're not sure as you're wrestling with this, then you want to seek advice and counsel on what the best option is for your particular circumstances. If you're struggling on how to pull all the pieces together for your retirement plan, you want a second opinion, go to the show notes. There's a link back to our website where you can find out how you can get access to a complimentary gap discussion to confirm whether there's any improvements you can make in your planning. Now again, flexible withdrawals are a critical piece of the TFSA. It's one of the great options. You can put money in, take money out. You don't lose your contribution room. I'd say the most important thing about the TFSA, though, is if you pull money out, generally speaking, don't put the money back in if you do have the money to do that until the following calendar year, because that can mess up contribution rooms. It could trigger some penalty costs on your account. Now, just a few points on contributions specifically. Of course, withdrawals, there's no tax consequences, but when you make a contribution, you can make a cash contribution from your account. So you write a check to your financial institution or do a direct transfer from your bank account to your TFSA. That's the least complicated way of funding contributions to the TFSA. Now, the other option could be an in-kind transfer. So you could have assets in a non-registered account, and you could transfer assets from that non-reg account to your TFSA account. Now, when you do that, there could be some complications. So you might be using an asset, let's say it has a capital gain attached to it. So let's say you paid $10,000 for it, it's now worth $20,000. So that gain is going to trigger some capital gains tax on your portfolio. So we want to make sure that you're aware of that. And when you transfer the asset into your TFSA, it's going to trigger a taxable capital gain. So you want to be a little bit tactical about which assets you're going to use and just be aware that that could happen. On the flip side, when you transfer an asset that has a loss, that loss will get triggered, but you will not be able to use that loss to offset future capital gains on your non-registered portfolio. So you might have to do a 2-step where you essentially sell the asset, trigger the loss, now it's in your non-reg account, then you move that asset into your TFSA so that you can get the funding looked after, and you've protected that loss that can be used to offset future capital gains. Another option is just take a look at your non-reg portfolio, and you might move a more conservative asset that doesn't trigger much tax with the idea that once it's in the TFSA, then you would put a more appropriate long-term investment. Like we said before in previous discussions, it's talked about in this video, you want to have, more often than not, your growth assets in your TFSA. So you can always do a change to that portfolio security once it's in your TFSA account. Now, investment options theoretically are very broad for the TFSA. So theoretically, you could have high yield savings accounts, GICs, stocks and bonds, ETFs, a whole range of options. Now, I say theoretically because the actual options that you'll have will be a function of what your financial institution provides. So some financial institutions are fairly restrictive. They may only have mutual funds, or they may only focus on savings accounts and GICs. They may only focus on their particular investment options with that financial institution. So generally speaking, if you want full optionality on the TFSA, you're best to have the TFSA with your investment broker, your investment counselor, your financial planner who's licensed to handle securities, so you have a wide range of investment options for your account. Because one of the nice things about a TFSA is you can actually stratify your investment priorities within that account depending on your goals. So you might have some money that's earmarked for retirement, some money that might be earmarked for some traveling, some money that might be earmarked for some short-term expenses coming up. And you can build a portfolio that actually looks after each of those core goals by using different investment options for the account. Another great benefit of a TFSA is that when you pull the money out, because it's not taxable, it's not going to interfere with other government programs. Two common examples would be old age security clawback levels and the GIS income supplement, which is impacted by taxable income. So in years where you might have higher expenses and you need to get access to capital, and you don't want to take income from the RIF or RSP in a larger amount, or you don't want to trigger capital gains on your non-registered portfolio, if you have that in place, you can always default back to your TFSA to grab hold of money tax-free so you don't impact some of these income-tested programs. Now, another great benefit of a TFSA is the fact there's no mandatory withdrawals. So, of course, with things like RSP accounts, you eventually have to move it into a RIF account, and there's statutory minimum withdrawals eventually that you have to take out. But with the TFSA, you put the money in, and there's no mandatory withdrawals where you have to take the money out. Now, when it comes to tax-free savings accounts, one question that comes up is what happens when I die? Well, the first thing is no tax is triggered. So unlike your RSP RIF accounts, which trigger tax, or if you have rental property with capital gains, tax is triggered. I mean, there's all kinds of things that can happen upon death where tax is triggered. Now, some of those taxes obviously can be deferred if you have a partner. But what's nice about a TFSA, if you name your partner as a successor holder, upon your death, all of that TFSA value can be transferred into your partner's TFSA. No issues at all. And there's no taxation at that point. You can have beneficiary designations listed. Often you'll see people list their kids as contingent beneficiaries. So if there's no partner living at that point, then the children receive the assets as beneficiaries, and there's no tax triggered upon that transfer for them. So TFSAs, for many clients, what I experience is that they view the TFSA as probably the last asset that they're going to use. They're going to use their non-registered accounts. They're going to use their RSP RIF accounts to supplement their income. And the last account that they're going to use is probably going to be the TFSA. And so as a consequence, they often view it as a legacy asset. So ultimately, that value may transfer to a spouse or partner, and then the value that is not needed for the spouse or partner will transfer to the children. Well, now that we've covered off some of the key features of tax-free savings accounts, let's take a look at the mistakes you need to avoid so you don't disrupt your ability to fully harness the power of tax-free savings accounts. So one of the first areas is just avoid overcontribution penalties. Now, that was a bigger issue years ago when tax-free savings accounts first came into play. People would routinely open up multiple tax-free savings accounts and stuff their maximum into more than one and then find themselves in an overcontribution position. So now that the accounts have been around for a while, that's less of an issue. But sometimes what happens is just basic bookkeeping and keeping track of contributions in or redemptions out can cause issues around penalties. So just keep good notes or work with your advisor to make sure you're never in an over-contribution position. The next area is a lot of people are still treating their tax-free savings accounts like savings accounts. And one of the problems, we've talked about this before, is in the wording. Don't view it as a savings account, view it as an investment account. And for many of you, because the tax-free savings account may be the last asset you'll tap into, the time horizon on that portfolio could be fairly long. And so you don't want to miss out on the power of the tax-free compounding by putting high yield savings and GICs in your portfolio. So an ideal place for the growth investments in your overall retirement plan would be the tax-free savings accounts for sure. So we'll take a look at an example of how much this could be costing you from an opportunity cost standpoint. I'm going to show you a calculator on our website that you can use to calculate the potential lost growth in your portfolio by not focusing in on your investment strategies properly. So here's the homepage. There's a link in the show notes to our homepage. And if you go down to the bottom of the page, you're going to find some tabs, and you just go to the Toolbox tab. Click on that. And at the bottom, you'll see online financial calculators. Click on that, and that'll take you to a menu of calculators. So once you get to the calculators, you're going to see a listing here. Here's one, which is called TFSA versus RSP. That's very relevant to one of the topics we've covered today. And there's another calculator called Savings Growth. That's the one we're going to take a look at in this particular example. So you can use a savings growth calculator just to fool around with different examples. So here we've got $50,000 in a couple of TFSA accounts. We're going to add $5,000 per year to the account. We're going to index these contributions each year at 2% per year. The starting age is age 50 for both accounts. The investing stop age, just in this example, is age 65, so we have 15 years of compounding in this portfolio. On the left side, we're using a 3.5% sort of risk-free return, and the portfolio will grow to $197,438 in my example within the TFSA. And then we've got a balanced to conservative growth portfolio return of 6.5%, and it will grow to $273,665 in our example. So a difference of $76,000 per year. Now, you know your own investment temperament, but I think the importance is use these kinds of calculators to sort of demonstrate what the potential difference is by making incremental changes to your investment strategy within your TFSA. The most important thing is use the TFSA for what it's intended to be really, which is a great place to park money with assets that will have above average growth over time, and those assets are most effectively compounding within the tax-free savings account. Now, tied to the overcontribution penalty discussion is just making frequent withdrawals and contributions and having lots of activity going on, and sometimes having activity going on in multiple tax-free savings accounts. That's not uncommon. So what I would recommend is ideally you want to have one tax-free savings account in your name. Deal with a financial institution or an advisor that can give you multiple investment options, so you always have full flexibility in the use of the account. And then you've got one account to worry about, because when you start using multiple accounts, it really creates some inefficiencies and can cause problems like the overcontribution issue we talked about. An area that doesn't get talked about a lot, but one just to be aware of, is that when you have foreign investments, let's say U.S. stocks or ETFs are buying U.S. stocks, there can be obviously foreign dividends, and when those dividends are paid, that jurisdiction will likely withhold some taxes. And those taxes are not recoverable, so it dilutes the overall return that you'll get from those non-Canadian investments. Now, you may still justify putting money, obviously, in the U.S. market or other investments because you view the total return being still high enough to cope with the fact that you've got these withholding taxes that are not recoverable. Generally, it's about 15%. There's not the same problem with your RIF account or your RSP account. There's reciprocal tax agreements, obviously, between various tax jurisdictions. The biggest one would be the U.S., where the U.S. recognizes the tax-deferred compounding of the RSP and RIF. But no such recognition exists right now as it relates to tax-free savings accounts. So it's just something to be aware of. And depending on the kind of investment you use, you just want to make sure you've got an investment that can give you above average long-term potential to cope with the fact that non-recoverable holding tax is happening in the background. Another issue relates to creditor protection, and this is not going to be applicable to all of you, but particularly for those of you that have businesses, maybe your kids have businesses or professionals, and they're worried about creditor protection. And so with a regular RSP account, you do have creditor protection, but no such protection exists with tax-free savings accounts. Now, there are insurance products that can offer creditor protection, but in terms of a regular investment product, If you're in a business, there's volatility to the business, or you're concerned about your financial situation and you're trying to creditor-proof your assets, then that's something you probably need to talk to your advisor about and see if you can restructure your tax-free savings account to offer a creditor protection in your overall financial planning. Now, another area that can trip people up, a mistake that people make, relates to just ignoring or not paying attention to beneficiary designations. Generally speaking, this is an area that probably doesn't get reviewed enough by people. Like, years can go by sometimes before people really focus in on their estate planning. So the bottom line is, good retirement income planning hygiene is every once in a while, look at your beneficiary designations on your contracts. And do those designations line up with your intentions from an estate planning standpoint? And you want to make sure when you talk to your lawyer with your will planning that there's a consistent theme between those two documents and that they don't contradict one another. But specifically, as it relates to the tax-free savings accounts, generally speaking, if you have a surviving partner, spouse, then you want to list them as a successor holder on the account. All that means is, as you try to maximize the value in that TFSA, on your death, 100% of that value gets rolled into your surviving partner's tax-free savings account. So it's just one way of doubling up the value that's in the spouse's account. The money's not subject to probate. It's a seamless transfer to them. So just make sure that that's something you're paying attention to. You can list your children as examples, contingent beneficiaries. That money cannot go directly to their TFSAs upon your death, but it's money that comes to them. And obviously, if they have TFSA room and they don't need the use of those financial assets right away, they could push that into their own TFSA accounts at that time once they receive the transfer value. And then in terms of mistakes, this mistake is not maximizing on contributions. Now, that seems like a fairly straightforward thing. Like if you have the cash, you want to seize upon this opportunity. But where it gets a little more complicated is in situations where, now you're retired, and let's say most of your money is in your RIF account or RSP accounts, and you haven't fully utilized your tax-free savings account room. Well, there could be an argument that intentionally taking more money than you need from your RIF account or RSP accounts could make sense. Pay the tax on the money coming out, and then push that money into your tax-free savings account to fully maximize on your room. So what you're doing is you're prepaying a tax, because obviously if you don't need the income right away, you're going to pull it out, you're going to pay tax that wasn't due right away and may be a tax bill into the future, so you've pulled it out. But you're going, if my marginal tax rate is going to be fairly constant over the length of my retirement, it could very well make sense to pull the money out, pay the tax, push it into TFSA. So now you're in a situation where you're getting an account asset that's growing tax-free within the TFSA as opposed to compounding on a tax-deferred basis like an RSP account. So you want to talk to your financial advisor, or you maybe do your own spreadsheet analysis, look at your marginal tax rates, how much room do you have between your current income that comes to you and the next tax bracket, and you might be able to justify pulling extra money out of the account and pushing that into the TFSA. Another issue sometimes is just looking at assets that might have deferred capital gains. So you might have a non-registered portfolio, but there's capital gains attached to it. You're reluctant to pull the money from your non-reg to your TFSA because you're going to trigger capital gains tax. But again, depending on your time frame on this transaction, if that money is going to be in the TFSA for an extended time, it probably does make sense more often than not to trigger the gain and push the money into your tax-free savings account. And then now you're getting the tax-free compounding within that investment. Well, if you need some help trying to pull together the idea of TFSAs and other planning tips into your own retirement income planning, go to the show notes. There's a link back to our website where you can find out how you can get a second opinion on your current retirement planning or how you can get your own customized retirement income plan. So be sure to take a look at that. And if you haven't subscribed to our channel, make sure you do that so you don't miss future content that we post on a regular basis. You take care. Bye-bye.